cigarettes.
Value investing is more than an investment strategy. It's a fundamental way of thinking about finance. Welcome to Value Investing with Legends, a podcast hosted by Tano Santos, the David L. and LCM Dodd Professor of Finance at the Hellbrun Center for Graham and Dodd Investing at Columbia Business School. Our mission today is to promote the study and practice of Graham and Dodd's original investing principles and to improve investing with world-class education, research, and practitioner academic dialogue. In this podcast, you'll hear from some of the world's greatest investors, their views on the investment management industry, how they develop their investment process, and how they see the field changing over time. To learn more and to subscribe to this podcast, please visit grahamandodd.com.
As Farron's put it, if you want to think about the value of consumer brands, few investors are as well versed as my guest today. He has been thinking about the all-important power of consumer brands for more than 3 decades. Do you want to know about the development of the beer business in Africa? Here's your man. Do you want to know about the strategy of this or that company when it comes to developing their brand in a new market? Here's your man again. But there are 2 other attributes that I think distinguish my guest from the many other investors. First, he was a trailblazer from the early part of his career in the 80s, looking for opportunities where few US investors dare to look. Second, he's a testament to the power of specialization, wise concentration, in a few industries he masters like no other investor. Tom Russo joined Garner, Russo & Garner as a partner in 1989.
Value investing is more than an investment strategy. It's a fundamental way of thinking about finance. Value investing is more than an investment strategy. It's a fundamental way of thinking about finance. Welcome to Value Investing with Legends, a podcast hosted by Tano Santos, the David L. and LCM Dodd Professor of Finance at the Hellbrun Center for Graham and Dodd Investing at Columbia Business School. Our mission today is to promote the study and practice of Graham and Dodd's original investing principles and to improve investing with world-class education, research, and practitioner academic dialogue. In this podcast, you'll hear from some of the world's greatest investors, their views on the investment management industry, how they develop their investment process, and how they see the field changing over time. To learn more and to subscribe to this podcast, please visit grahamandodd.com.
Welcome to the Value Investing with Legends podcast. My name is Tano Santos, the David and LC Dodd.
Welcome to Value Investing with Legends, a podcast and to improve investing with. To learn more and to subscribe.
I'm the faculty director at the Hellbrun Center for Graham and Dodd Investing. When in 2003 Morningstar decided to start its Fund Manager Lifetime Achievement Award, it had to choose an inaugural honor. When you start a prize, you better get the first right, as it determines the reputation of the prize from then on. As it happened, Morningstar chose 2. Ralph Wanger, the longtime portfolio manager of Acorn Fund and then later of Vanguard Asset Management. And the other one is my guest today, Jean-Marie Reyard. Welcome to the Value Investing with Legends podcast.
Thank you, Tano.
Jean-Marie Reyard started his career as an analyst for Société Générale International Fund, eventually becoming the portfolio manager of SocGen International Fund, which eventually became in 2000 First Eagle Global. He managed for almost 25 years the First Eagle Global Fund and the Overseas Gold Funds since their inception in 1993. With First Eagle Global Fund, he returned an annualized 15% for over 25 years. Incidentally, he and his co-manager Chancellor Bort were named also Morningstar International Stock Fund Managers of the Year in 2001. Also incidentally, when we wanted to have our inaugural William von Muffling professional practice in the finance division of Columbia Business School, we had no doubt that it had to be Jean-Marie as well. So whenever you want to get something going, Jean-Marie Reyard is your person. So Jean-Marie, I want to talk a little bit about your origins, how you get into the asset management industry, how a good boy from Poitiers, a good Catholic boy from Poitiers, ended up as a legend in the value investing world. So let's talk a little bit about those origins.
Right, so I graduated from a French business school, HEC, which today has a good reputation. In my time, did not have a good reputation. In fact, our nickname was the grocers, les épiciers, small corner grocers.
Yes.
To the point that the people who graduated the same with me decided either to get an MBA in the US or to try the École Nationale d'Administration, ENA, which is in France the pathway for students who want to go into politics or go to be high civil servants.
Right.
And in 1960, to the point where, to my mind, the courses were thoroughly uninteresting, except for one, which was the course in security analysis.
Uh-huh.
I was really intrigued, and when I graduated in 1962, there was an opening with a French bank, Société Générale, to do security analysis, so I joined them.
So it was truly, and this is a very good lesson for my students, that somehow a good class can make a difference in your career.
That's right.
That's wonderful. And you remember what is the material that you used? You guys were reading annual reports, you were looking at all sorts of assets.
Let me put it this way. I think I learned how to read a balance sheet well.
Well, that's very important.
I don't even remember I'm getting old, so I forget. I don't even remember the name of the professor, but to me, I think I would not have joined the French bank to do security analysis if it hadn't been for the course. Right.
And then you stayed in Paris as an analyst for Société Générale.
Yeah, until 1968, when the bank decided to send me to New York for a year or two. What had happened at the end of the 1930s is one very smart man at the bank figured out that the Germans were coming. Must have been 1938 or 1939. He went to see the president of the bank and said, look, I think the Germans are coming, and if I'm right, why don't we send a fair amount of money to New York in a discreet manner so that the Germans won't figure it out.
Right.
And it's exactly what happened. They did it discreetly. It was a substantial amount of money.
So they set up a fund on US Treasuries or something.
That's right, that's right. And with the interest, at the end of the war, they were sitting on the big pile.
I see.
And they decided to do wholesale banking in New York, and indeed their offices were on Wall Street, and there was no retail banking. And what happened is that there is a Mr. Bick of the ballpoint pens, who had been very successful in France and in some other European countries, who decided he would like to try and invade the American market for ballpoint pens.
I see.
And he went to see a number of American banks in New York, and they said, yes, we will lend you money as long as you provide your own personal guarantee. And Mr. Bick was not completely confident that he would be successful, and so he did not want to provide his personal guarantee. So then he went to the gentleman who was running the wholesale banking branch of Société Générale in New York, and he got loans. So that was a success, and they managed to develop the wholesale banking business fairly well.
And what were your responsibilities when you first arrived in New York?
When I first arrived in New York, they already had a financial representative who was lodged in the offices of the bank, of Société Générale, here in New York. And I was his deputy, I think, more than an assistant. Like being alone or something. And I was supposed to provide investment ideas in American securities to headquarters in Paris.
And this is because at that time Société Générale wanted to diversify that portfolio, make it a little bit more of an active portfolio, have dollar exposure. What did they want?
That's when Société Générale decided it would be nice to have somebody on the spot in New York who would develop relationship with a number of Wall Street sell-side firms. Luckily, very quickly, in the spring of 1968, I ran into two French students at Columbia Business School.
That's the beginning of everything always.
And their interest was not investing, their interest was marketing.
Right.
But they knew that mine was investing, and because Van Graham had retired from the business school in 1965, it was only 3 years before, and people were still talking about Van Graham at Columbia Business School. So they mentioned Van Graham to me, and I went to...
You knew nothing of him.
I know, I had never heard the name. And I went to a bookstore and I bought Security Analysis and, more importantly, The Intelligent Investor, because the way they were investing in Paris at the time was basically they were trading the big stocks in the index. That was not satisfactory as far as concerned. And in a way, nobody knows whether it's true or not because only he knows. But there is a French writer, a French poet, very well known, Paul Claudel, who was agnostic. But for aesthetic purposes, he decided to go to Chartres and visit the cathedral.
Uh-huh.
And he said that he was standing by a pillar in the cathedral and he was illuminated by faith. in a much more modest vein, I was sort of illuminated. I had found what I was looking for, an investment approach that suited me.
It's interesting because this story of reading The Intelligent Investor is one that has been related to me by many other investors, that they read it the first time and they are completely taken by the insights, and that's exactly what they were looking for, that they had those ideas, those intuitions, they could never quite formalize them, and that's what Ben Graham does for them.
And as you know, even though Warren Buffett has made substantial and successful adjustments to the teachings of Ben Graham, with the moat and everything.
Yeah, we'll come back to that topic.
Nevertheless, Buffett continues to say that The Intelligent Investor is the best book about investing ever written.
Me as an academic, it's a remarkable book to read because to some extent these man's insights are 30 years ahead of his time, particularly what concerns behavioral finance. as well as many other topics on valuation,
Right.
by the way. So many of the statistical realities that have been confirmed later on.
And if I may, academics with the 60s developed a number of ideas.
Right.
To my mind, without what Graham did, he took into account human nature.
Right.
The idea that with the market, he goes berserk every now and then, either on the way up or on the way down. And that one has to make adjustments. So that's where opportunities are open by the fact that the great majority of investors
Why
get
can't I?
frightened if the stock market declines and get over-optimistic if the stock market has been going up for quite a while.
Right. I think these ideas have always been very difficult. So it is true. I think you're exactly right. That the history of academic finance in the 50s and in the 60s follows a particular path that I think determines a little bit the early history of research in asset markets in the 1970s with giants like Markowitz, Merton, Miller, Gene Fama. But by the late 70s, with the work of people like Bob Shiller, Dick Taylor, all of them Nobel Prize winners, Danny Kahneman.
Oh yes, the heavy old school I think was considerable help there.
Exactly. You know, so that's really developments of the late 70s when people come to terms, so to speak, with the faults or inadequacies
Right.
of the framework that was being developed in academic finance. It took some time for people to accept those ideas. This is very standard in science. I always thought that many investors are a little bit harsh with academic finance in this. You know, it is true, it took some time.
Right.
It eventually became a big component of the way we think about
After
financial
all,
market.
after all, Mr. Kahneman was an academic.
Yeah, of course, after all these people,
Right.
Shiller,
Yeah, that's right.
Taylor,
That's
they're all great academics who were fundamental contributions in the. So let me bring you then back. So you read this book. Now you have the funds to. You are an analyst. You don't have responsibilities as a
No,
position there.
but I tell headquarters in Paris that I came across a book which I thought was very interesting. Yeah, never heard
You
of
told
it.
them about the book. This is
Yeah.
wonderful. You're such an innocent man.
And they had never heard of him, but then I had never heard of him until
Yeah.
I was told to buy the book. And when I tried to explain Graham, he had zero interest. So, and then in 1970, sometimes bankers can be somewhat sheepish. There is another French bank, Crédit Lyonnais, which in 1969, I think, had opened a securities firm in New York, as opposed to simply having a financial representative. Société Générale, they said, well, Crédit Lyonnais does it, we got to do it.
Yeah, of course. Yes.
So they opened the securities firm, and then they said, well, what do we do? Well, among the things they could do was to start a small fund. And they started a small fund in the spring of 1970, registered it with the SEC, registered it with the state of New York, but that was all. And maybe 2 or 3 other states, but very limited the number. And then I thought, well, they'll give it to me to run. But they had so little confidence in me, they got a sub-advisor, Smith Barney, which was and still is not at all a value shop.
Right.
And it was the sub-advisor who was making all the decisions.
I see.
And so I was
I'm still an
his
analyst,
boss.
essentially.
No, yeah, but much more likely to listen to what the Smith Barney people were saying than to what I was saying.
And what do you do then?
Well, I was sending papers to Paris talking about stock X or stock Y, and nothing happened. After 6 years, I got married in 72, and then they said, look, you've been in New York already 4 years in 72. Why don't you come back to Paris in a year or two? Because if you stay too long outside Paris, the headquarters begin to forget you.
I see.
So in 1974, I moved back, and they made me the promise, which was to show that when you have a promise, you should get it in writing.
Right.
That I would have some money to manage.
You're dealing with a large international bank that is threatening to forget you.
And then they said, well, we changed our minds. At that time, the French equivalent of the American mutual funds had been just created a year or two before that.
Exactly.
And there again, they had so little confidence in themselves, and in me in particular, that they decided to use a French sub-advisor for the new instrument, which was a clone of the American mutual fund.
And can I ask you something? I mean, this is important for, I think this is actually quite relevant. That were they concerned that somehow, look, our man there is wonderful, Jean-Marie Rivière is wonderful, but we don't know the local market. We're very exposed to
Right.
these American
Right.
investors, we
Right.
know the market much better, it's a different
Right.
environment, so we want to have someone.
Yeah.
Was that the argument that they had in the back of their mind? Because if
Yeah.
that's the argument, it's not an entirely unreasonable.
No, you're absolutely right. How could they have confidence in me on the basis of my having read a book?
Yeah, exactly. So,
Even though I had, between 62 and 68, I had run the portfolios of some wealthy French people.
in the United States, the portfolio.
No, portfolio,
Overall.
no, mostly France,
I see.
and a little bit Germany, England.
I see.
So my experience was I had run relatively successfully European portfolios. So what do I know about New York even after a few years,
Right.
particularly by comparison with the Wall Street firms?
Right.
Because Wall Street, and maybe that's why I had agreed to come to New York in '68, was a little bit the mecca for investing.
Right.
So I go back to Paris in '74 and I'm not running anything. Well, I'm supposed to run something, but in fact there is an investment committee that makes the ultimate decisions. And I tried to suggest a few Ben Graham type stocks and they have no interest. So it's a sub-advisor that in effect runs the firm. And then by 1977, 78, I'm beginning to get restless. And they say, well, this time around, it's for good. We still have that small fund that was created in 1970. We'll kick Smith Barney out, which they did, and then you can run the fund. And I think the reason why they agreed to let me run the fund is that it was only $15 million in size. So they said to themselves, even if Jean-Marie screws up,
Yeah.
which he probably will,
Yeah.
our reputation will not really be blemished as a result.
Right. So then you come back to New York in the late 70s.
In 1978, and very quickly I read a piece by Lee Cooperman, a graduate from Columbia Business School.
I mean, connections to Columbia are everywhere. You've been stalking us for now several decades. Yeah.
And he's written a small piece about Warren Buffett. He said, well, there is a man in
Famous, of
Omaha,
course, yeah.
who understands businesses and has good ideas in terms of investing. And I get, that was before the internet and everything. And so I asked for the annual reports of the previous 5 years, I think. They sent it by the mail very nicely, quickly. And I read it and I say, well, this is not Ben Graham, but it is derived from Ben Graham. And the idea of the moat, if I remember well, it was originally the idea of Charlie Munger.
Right.
The idea that there are businesses that are better than others, lines of business that are better than others. And I think at some point, I'm not sure he's repeating, I think at some point Buffett said, hey, I don't need geniuses to run the businesses in which I invest. I only need competent and honest businessmen. It's the quality of the business that matters more. I think he also said something to the effect that because if I'm unlucky, an idiot at some point may run that firm. So,
So let's talk a little bit about that. So now for the, this is actually quite auspicious because you're right to run finally the funds that Societe
yes,
Generale has in
right,
New York.
right.
By then you've been drenched in the
Both.
ideas of Ben Graham and
That's right,
Buffett Munger, so
that's
to
right.
speak.
Right.
And you immediately recognize the intellectual contribution of the Munger-Buffett or the Buffett-Munger
Yeah.
approach and how it adds to
Yes,
the traditional
I
investing ideas.
know, I recognize it, but at the time I'm alone. I'm alone with half an accountant, no salesman, no analyst, because the attitude of the French bank in Paris is to say, hey, you're small, you're too small, you are not making any profit out of you from the fees. I said, but it's a catch-22.
Exactly. And so you were doing everything by yourself.
Yes, that's right. At that time, the famous story about Napoleon, he's with a few aides, and one of the aides, one of his entourage, speaks ill of one of the generals. Oh, he's lazy, he chases women, he's corrupt.
Yes.
And Napoleon stops him and says, but wait a minute, at the last battle, he behaved very well, successfully. And the aide says, oh, he just got lucky. And Napoleon says, lucky general, that's what I want around. because
that had anything to do with your
because
success,
I mean, on the battlefield, things get messy.
All right.
So,
But let me bring it in. So, a couple of open topics, and I want to return to both of them. But first, just a question of curiosity. So, you're by yourself in 1979 with half an accountant, we don't know what half an accountant is. Let's not explore that too deeply. There are thousands of securities you can be looking at. We don't have the internet, so everything is a little slower. That creates advantages, but also costs in a way. It is more difficult to access information. So, how do you structure your search, valuation process at the time?
as I said, in a sense, I'm lucky because in Europe, in continental Europe in particular, I noticed two things.
That's true.
The first is that the accounting is extraordinarily conservative. A friend of mine says, Germany, the Germans, they tend to be pessimistic people. They think, well, maybe World War III is coming or something like that. They have what the Germans call Angst, which is the word for anxiety.
Right, exactly.
They have Angst.
Well, the early 80s were a scary period in Europe.
That's
I mean,
also
people
checkmate.
in the audience, that was that. The geopolitical situation in Europe
That's
was
right.
not what it was today.
And so from an accounting standpoint, the profits are not overstated, they're understated. By how much is sometimes difficult to figure out, but one can see that the profits are understated. And the second thing is that small stocks are basically ignored. Everybody wants to buy the big stocks throughout continental Europe. And so to me, that was in the US
there.
at the late 70s, already the growth approach to investing
Yeah.
had begun.
Or this
And
one.
portfolio managers want to buy the stocks of companies where they think there will be substantial growth.
Knight C3.
So what you're saying is that by then you were bringing to your US investors some European exposure to stocks that were completely outside the.
No way, the fund could not be sold in Europe
Oh, that's right.
because it was registered with the SEC just as, if you have a fund, you cannot sell it in the US. So it could be sold in the US, but it was registered only in New York State, so hence the 15 million. There were some fund investors at the time because if you went to a branch and said, I want to buy that fund with no marketing, no papers, you could do it. But of course, very few people did it.
Of course, yes.
So it was mostly, my father-in-law and other Americans who were investors and myself who were investors. So there was the small stocks in Europe where the profits were understated.
And that you knew well, where you knew that universe.
Well, that's right.
What?
That's right, because I had been, for 5 years. And then in the US, there were small stocks.
Oh my god!
Some style stocks.
Yeah, because we're talking about the 70s, the market is relatively depressed.
Oh
Valuations
my.
are
That's right.
So it's a good time to be about
Yeah, that's right. That's right. So
What am I
the first half of
doing?
the 1980s, very much helped by the fact that the kind of stocks I'm looking
What?
for are not popular currently.
Exactly. Right.
And I'm considerably helped by the fact that Morningstar, I think, opens their doors in 1984, and very quickly they write positively about our fund, our small fund.
Very good. Because I always felt that in the history of value investing, one of the interesting things is that if you look at the valuations in the mid-70s, from the mid to the late 70s, they're incredibly attractive. Multiples are very compressed. It's like a candy store if you're a value investor then. But that's exactly when Buffett and Munger start talking about the mode and the business operations. They're thinking in a way ahead of time when you could afford to still be a traditional value investor. That's kind of the...
And in fact, Buffett does well in the 70s, in spite of the fact that he does not own oil stocks, does not own gold mining stocks, but he is very smart. So he says, hey, when there is inflation, you don't want to own the stocks of capital-intensive businesses because their profits are basically overstated.
Right.
You want to own the stocks of companies in service
Sacrifice
businesses,
the road.
which are not sold advertising stocks. You own all sorts of media stocks and etc.
So can I ask you then, so I guess then my question, when we go from the traditional Ben Graham approach to the Munger Buffett approach, let's call it that way, we go from essentially comparing market prices to intrinsic value in a very disciplined way by focus on the balance sheet.
In a somewhat static manner.
Exactly, in a somewhat static manner. That's the way you look at the snapshot of what the company is at that particular moment, to one that requires of you going deeper into the business operations to understand. So I want to talk a little bit about that with you. So how do you actually approach this matter? What kind of, because in a way the Munger Buffett approach requires of you becoming a person who understands the business operations. How do you go about this process of understanding the business?
Well, there's no doubt that the Buffett
50
approach
seconds.
is much more potentially rewarding than the Graham approach, but much more difficult than the Graham approach.
Right.
And I would add that particularly today where you have the internet, which is a very disruptive force, has already half killed the newspaper business.
Right.
Anyway.
Well, the Munger Buffett has a very qualitative aspect.
That's right. That's right. Because anybody can figure out that company X has been successful for the year or two, and it looks like they will be successful for another year or two. But businesses, and then Buffett says, on top of all that, Buffett says, I almost never sell, which implies that he has to be very successful in uncovering moats, which is difficult to do. Because what is difficult is to figure out, hey, that business, the odds are that it will be successful over the next 7, 8, 10 years,
Exactly.
maybe more.
Well, also it solves this problem. If you never want to sell, you need to have a business. You need to be invested in a business that can reinvest for you those
That's
profits.
right.
So
That's
that solves
Right.
kind of a big. It's kind of like farming out the investment operation to the
Right.
manager of that firm who's
Right.
going to be doing the good
That's
capital allocation
Right.
decision. So, do you look at those things? Do you look at the, for instance,
Shoot.
quality of the capital allocation
Go
decisions
here.
inside the firm, management? Do you look at those things? How do you approach these?
I'm more inclined towards believing that one, the line of business is theoretically at least attractive.
Right.
And that was the case, for instance, when I bought Lindt and Sprüngli, the chocolate business, which already was well known in Europe. But unfortunately, that's where management comes in. Unfortunately, it had been run by Rudi Sprüngli of the Sprüngli family, changed chief operating officers every 2 years or something like that. And where obviously, in view of the line of business that he had, was not as profitable as it should have been.
I see.
Because,
check.
good European chocolates, you can sell them at a relatively fancy price. This is not a commodity. You get a name like Lindt and Sprüngli, and so I buy the stock at 7 or 8 times earnings,
What year are we talking about more or less? So,
80 or 81 or
so
something.
they're not present in America or anything.
No,
like
no,
that.
no,
Yeah.
no. And for a while, the stock does nothing to some extent because Rudy Schwongli is not totally capable.
Right.
He's sitting on a good line of business, but he's not totally capable. But Rudy Schwongli makes a big mistake. At the age of, he was already 70 or something like that. He gets rid of his wife for 50 years and
Oh my
married
gosh.
an American woman. Which was already
Yeah, that's kind of
Wow.
an American woman who was a member of a cult, not a criminal cult, I think, a member of a cult, to the good Swiss society that was bad. And after a few months, the family, which already was not very happy because the stock had gone nowhere, the family gets rid of Rudy Schwongli. Either by luck or because they were very smart, the family was smart, or somebody else was smart.
So,
They hire a man who was a big gun for Johnson & Johnson in Europe, originally from Austria or Germany. And he's still there, although I don't think he's chief executive officer anymore. He's a chairman or something like that. And he improves the
operations.
operations
Exactly.
considerably. And at some point, he decides to try to invade the American market. But he understands that we cannot go to Walmart or to another distributor like that because the answer will be, we're not going to do it. I mean, the American taste for chocolate is very different from the
This is a very
from the
important-
European
Yeah,
chocolate.
this is a very important point. I like this example very much because this is something that candy doesn't travel well. That's one of the surprising
Right.
things
Right.
that it takes a lot of effort
dang.
to develop the brand of a particular
Right.
chocolate or any.
Right.
Even when you're dealing with very high quality
Yeah.
chocolate, at that time, I think our American friends will get offended if we tell them that the quality of American chocolate was abysmal compared to the quality of Swiss or Belgian chocolate in Europe.
The way they put it, it was to say, hey, it's different.
It's different, exactly.
It's
That's the
different.
point,
But
the
it-
delicate way of putting it, yes.
But if they try it, Americans will like it.
Of course.
But they have to find a way, and the way they found was to have stores. There is one on Fifth Avenue
Yes.
in New York.
Yes.
To have stores. I don't think they never pretended they were making money with the stores, but what they were doing is show the Walmarts and the others
Yeah,
that hey,
did not
the American people
give
are
a-
interested in
High quality
Oh,
chocolate.
yeah.
Yes.
with European taste, different from
Hershey's now.
the Hershey
Yeah.
right, and some of the others. He did such a great job that one thing with the Buffett approach that is difficult, and there is no solution really, is if the stock, like Clinton probably, goes up considerably, and at some point you can say the stock is overvalued. Maybe I should sell it.
Right.
But the Buffett approach is, and that's why Buffett, I think, is intriguing. His
Ooh.
attitude is, if it's modestly or moderately overvalued, I will not sell it. Because, it's difficult to find businesses with modes. Maybe for a year or two, the stock will not go up. For all I know, maybe it will go down a bit, but I will hold on to it. It's only, and he said that apropos Coca-Cola, which was extraordinarily
Yeah, there was no
overvalued
need
in
to
the
go for
90s.
those
He
bonds.
said he conceded at the beginning of the century that maybe he should have sold at least some, and he didn't.
Well, many investors, in a way, have particular rules that, say, if the enterprise value
Oh.
to EBIT is particularly high, I'm beginning to get worried, say, about multiples compressing on
That's
the
right.
and doing returns.
Right.
And there are companies that you can own several times throughout your investment career.
That's true.
So in that sense, the
Right.
market gives you
Right.
a price that you
Right.
think you pass, so to speak, and then you keep it in the folder. So when it comes down again, you buy it because you like the business, you understand it. Is that how you think as well about?
No, I'm more inclined to, not always, because of course, what the investor has to be afraid of is what they call a round trip, where you buy a stock at $25, it goes up to
Who
50,
needs- and I played
and then something
this.
happens, it goes back to 25. It's a
Right.
round trip,
Right.
one kind of thing to do.
Yeah, so I think there's a difference between trading on the volatility of the stock and being very short term. Appreciating that sometimes that stock is at such height, so to speak,
Right.
that it's difficult not to
But-
you get with it because capital and taxes.
One thing about investing, I think it's good not to think too much that one is a genius,
No, of course, yeah.
because the stock market will bury you.
Yeah. By the way, this is something that comes across all your writings. And, you wrote this wonderful book called Value Investing Makes Sense, not a very
Thank
subtle
you,
title,
thank you.
in Valor Editions in 2000.